First, a big thank you, Ken, for joining us. Ken Freeman is the director of the Road to Wall Street program at Rutgers Business School. He's also an experienced professor in the finance and economics department who is very well rated by his students each year. His previous industry employers include Deutsche Bank and Value Architects Asset Management. Ken is particularly skilled in Microsoft Excel, valuation, corporate finance, and private equity. He earned his bachelor's degree in finance from Rutgers Business School and his master's in financial management at Boston University. Ken teaches for Rutgers Business School executive education programs, including the Mini-MBA Healthcare Management. We're thrilled to have you, Ken, to share your insights with our audience, and I'm going to hand things over to you to get started.
Awesome. Looking forward to it. So thank you, everybody, for attending today. This will definitely be a very valuable session from a knowledge perspective. I think one of the things that's challenging for most of us when it comes to finance is it's very amorphous, right? You'll turn on CNBC and you'll see like Jim Cramer and all these other talking heads, and the market goes up and the market goes down. And, people will talk about things like Bitcoin and, all sorts of stuff like that. And it gets to be very confusing. But at the end of the day, in terms of making financial decisions, it really is as simple as what we're going to look at today. Effectively, you have some sort of asset. That could be a stock, that could be a project, that could be a house, an investment property, and you have to determine whether or not it's worth purchasing. So we're going to go through the methodologies that you would apply. This is literally what they do at big corporations, Fortune 500 firms, all the way down to individual entrepreneurs. So I'm happy to reference, my past experiences. I owned a laundromat and a pizzeria, and the same exact methodologies are used in small businesses, whether or not you should move forward with a financial decision, move forward with a particular project. So whether you're in corporate finance on Wall Street, or you're in, finance within a corporation like FP&A, or even within Rutgers, any organization where you're trying to make a sound financial decision. But again, you could also apply this to your own personal life, and I would encourage all of you to do that. Right now, when we look at the market and the environment, and we look at things like real estate, right? Is it a good time to buy? Is it not a good time to buy? The methodologies that we're going to go over today are what you can apply to make that determination. And we're going to get into kind of the nuances of each piece of this, but it's really, truly this simple. You could do a PhD thesis on this stuff, but it really is kind of like back of the envelope type simple. So without further ado, let's go. So there's 3 investment analysis methods that are going to be utilized. One is payback, okay, which basically high level is a determination of, based on when we make our initial investment, how long does it take us to get our money back? Effectively your break-even point. The next methodology is NPV, or net present value, which effectively says, based on what I'm investing and based on what this particular asset is going to produce in terms of cash flows, am I going to end up with a positive investment on the net or a negative investment on the net? And then last but not least, we have internal rate of return. The way that internal rate of return works is it actually gives us a return, a quantifiable return amount, a percentage return amount. So all 3 of these methodologies are utilized. There's different rules for each methodology, and that's what we're going to get into. So first one, okay, would you go ahead with this investment? Let's say that you have a medical practice, okay? You're a doctor, you're a chiropractor, what have you, and you're considering whether or not you should purchase a billings and collections software. The software costs $180,000, but it's going to result in savings in clerical salary of $40,000 per year for 7 years. Okay, so effectively the cost is $180,000. The benefit is 280,000. So the benefit outweighs the cost. So there's no tricks here. There's no like shell game here. You know, just feel free to pop into the chat. Would you move forward with this investment? Yes or no? Okay, we got yes, 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 yes. I like the on the surface, yes. And I'm not trying to trick anybody here. This is just benefit outweighs the cost. What we're going to do is effectively see each of these methodologies in action and then see a way that we can refine it. So James says maybe why 7 years? 7 years is the life cycle of the software. After that, you'd have to get an update. Okay, need more information? That's fine. Okay, 7 years too long. Lots of interesting stuff here. This is why I like, you know, this interactive nature of it, because people start kind of thinking, okay, there's more to the story here. All right, good. Depends on the recurring cost of the software. All right. Yes, is the cost up front? Yep, the cost is up front. Discount rate is unknown, so there's no real relevance to the discount rate for payback period, but we're going to get into that. So you're actually getting to the next methodology. All right, good. All right, so lots of really great insights here. High level, like very superficial. When you're looking at a project like this, you're looking very simply at the costs versus the benefits. So there's a bunch of other things that came up here. What about maintenance costs? What about this? What about that? So if you were to look at like purchasing a car, right? If you purchase it versus take mass transit, all right, you could take kind of that same approach. You're not going to include, you know, all of these other ancillary items because you're just looking at the project on the surface. So you could say hypothetically, like if I have to take the train or the bus, I'm going to have to get a heavier coat, or I'm going to have to get more umbrellas. I'm going to have to get galoshes, and I'm going to have to incorporate that. Versus if I have a car, I have the oil change, I have, you know, windshield wipers and all of that stuff. It's basically, what does the car cost per month? 500 per month. What does the bus or train cost per month? 100 per month. All of those other ancillary costs kind of get eaten up along the way. That gets like into kind of different methodologies, but basically high level here. The way that we have to think about this is we have clerical staff that can do this job, or we have software that can do this job. Okay. But all the points that you brought up are very important. And I'm glad that you're looking at it in a very, you know, deep manner, because part of the clerical savings, one could say, okay, does that 40,000 include insurance? You know, what happens if the software goes awry? You know, are we not able to collect our bills? On and on and on. So high level, you know, there's clerical staff in place, but we're not going to need as many clerical staff if we purchase this billings and collections software. So we have a benefit of 280,000, a cost of 180,000. So the answer is yes, we would go along with this project. But a few of you mentioned something very critical and very important. You said, why 7 years? Where does the 7 years fall into play? And that's something that we're going to get into, because that's an excellent point. So payback allows us to see how quickly a project will return the initial investment back to the company. All right. So the way that payback methodology works is companies establish rules around payback when evaluating a project. So for example, a company might decide that all projects need to have a payback of 5 years or less, meaning we need to get back our original investment within the next 5 years. So if we look at the previous example, and some of you did this math in the chat, if the cost is 180,000 and the savings is 40,000, we get our money back in 4.5 years. Okay. So basically by doing this billings and collection software, the savings that we get from the clerical salary, we meet our rule. Okay. The rule in this instance is 5 years. We need to get paid back on this project within 5 years. So 4.5 ends up meeting that particular goal. Okay, literally as simple as that. Now we're going to get into other methodologies, which get into discount rates and all of this other stuff. But high level, as long as we get paid back within that 5-year time frame, we would move forward with the project. So pros, very easy to understand. Okay, when you're going to recover your initial investment. And this allows for thumbs up, thumbs down decisions to be made based on simple cutoff date rules. Cons, and there are several, okay? It doesn't take into account time value of money, okay? One of the things that we've talked about recently, right, in terms of the market environment, inflation, okay? So one of the issues is that 40,000 savings in a few years is not going to be worth the same amount as the 40,000 savings today. And that's something that we obviously have to address. Just like $40,000 20 years ago isn't the same as $40,000 today, that savings would have to be adjusted as well. Now, one thing to understand is the billings and collections software, that is guaranteed, right? Your initial outlay, that cost, that's set. Okay, but the value of that savings will definitely vary over time. Okay, future dollars are worth less in today's dollar terms. So we'll get into that momentarily. Now, discounted cash flow, basically taking into account time value of money, should be the way that we evaluate payback because it does take time value of money into account. The other thing that's very interesting is payback ignores cash flows that occur after the payback period is reached. So when we think about it, let's say we could sell this billings and collections software at the end of the term. We didn't factor that into this analysis because that's not part of payback. If you could sell, let's say this appreciates in value and becomes worth more money. Let's say we could sell it for 200,000 at the end of the 7 years, or even the company says, we'll buy it back from you at the end of the 7-year term for 180,000. That changes everything, but that's not going to be included in the payback period methodology. Okay. So ultimately, payback does have value. It's very simple, thumbs up, thumbs down decision making. Now, here's the interesting thing. Most people, when I teach this, they say, oh, everybody knows that this doesn't make sense. This isn't used in the real world. And I would caution you with that thought process because it's actually used very often. All right. So in the world of small business entrepreneurs, there's a very simple rule of thumb. The first year you lose money, the second year you break even, the third year you make money. What's that? That would be a payback period of 2 years or less. Meaning if you go buy a business, the first year, you're not going to recover your initial investment. Ideally, at some point within the second year, you should break even, have all of your investment back. And then after that, that's when you should pull a profit. So that's a legitimate rule of thumb that's used in the world of small businesses, whether it's laundromats, bagel shops, pizzerias, etc. That is the rule of thumb. And if you ever tried to purchase one of these businesses, that is one of the ways that they get priced. Now, that's very different from, a corporation or, a publicly traded entity. But for a small business, because you have a lot of factors going on there, right? Some of the money's cash. They don't report all of it on taxes, what have you. So that gives you that level of flexibility. Another very interesting one. When I attended Rutgers, I remember one of my friends lived off campus in a house over on College Ave. So he told me that he noticed that the properties were very closely priced. And I was like, okay, well, I guess that kind of makes sense. So he ended up inquiring of the landlord. So he said, hey, I've noticed that a lot of these properties are very similarly priced. He said, is there some sort of equation that you use? And the guy told him something very interesting. He said 100 times monthly rent. And so he said, wait, what? He said, that's the way that we price properties here. So he said 100 times monthly rent. He said, yep. So now let's think about that. If you were to buy a property that was 100 times monthly rent, so let's say the monthly rent's $3,000, multiply that by 100, $300,000. What does that mean? That means you're going to recover all of your initial investment within 100 months. which is 8.3 years. So if you think about it, it's like, wow, now I don't think they thought about it in this, fashion, but ultimately there's a payback piece to that. Okay. So anytime you look at some sort of initial investment, some sort of time to recover that investment, that is payback period. Now, remember, in that example, we're not talking about, well, what could you sell the house for in 10 years? That's not part of the analysis or the evaluation. We're literally looking at purchasing an asset. It produces cash flows. What does that mean in terms of when we get paid back? So I think we could all agree there's certain deficiencies with payback period that we have to be able to overcome. The main one being time value of money. So how do we overcome that deficiency? That's through methodology number 2, NPV, or net present value. Okay. So very simply, the way that NPV operates is we're going to choose projects that have a positive net present value. Okay. So I'm going to walk us through the analysis at the bottom. So if you look on the left-hand side, that was basically what we had with the payback. Now what we have to say is those future dollars are worth less in today's dollar terms. So here's how to think about this: time value of money. Okay. $1 today is worth more than $1 in the future. Now, there's 2 ways that you could think about this. Way number 1 is the following. If I said, hey, I'll give you 2 options. One is take $1 today. The other one is take an exact dollar in the future. You should always take the dollar today. And the reason being is that dollar today you can invest and you'll end up with more than $1 in the future. Okay. So in this particular example, we have a cost of capital of 10%. If you took $1 and you invested it at 10%, a year from now, you'd have $1.10. So $1.10 is worth more than $1. Hence, you would prefer the dollar today over the future dollar. Similarly, another way that you could think about it is say, okay, what if I have the dollar today and the dollar in the future? How could I compare those? The other thing you could do is you could take that future dollar and discount it back to today. Basically, bring it into today's dollar terms. So if you look up top, you see CF over 1 plus R to the 1. Okay, it's really 1 plus R to the T. All right. Every time you go to a future year, you increase that T. So year 2 would be 2, year 3 would be 3, on and on. Now, what that's going to result in is every further year into the future, that dollar is going to be worth less in today's dollar terms. So if you actually look at that discount factor, okay, year 1, what that means is that $1 a year from now is worth 91 cents today. If you look at year 2, $1 2 years from now is worth 83 cents today. $1 3 years from now is worth 75 cents today. Now, that's predicated on the cost of capital of 10%. So how you can calculate that discount factor is very simply 1 divided by 1 plus the rate to the exponent of t, the time frame. Okay. So that is how we calculate the discount factors. And a very good question was asked. I appreciate that. How do you determine the cost of capital rate? Okay. That is a function of risk of the company, but I'll give you a very simple way to think about it. You might say, hey, Ken, any investment that I'm going to make, I want to earn at least 10%. That's your cost of capital. Or you could say, hey, Ken, I'm borrowing money from my aunt in order to make this investment. I say, okay, how much are they charging you? 10%. Say, okay, well, that's your cost of capital. Okay. So ultimately, when you have a publicly traded company, that's going to somewhat be determined for us. Okay. Because we think about like rates, right? You always hear this rates, this like amorphous term in the market. Well, rates are determined by the market. So for example, if you went to the bank right now and you went to go get a mortgage, there's a particular rate, 30-year mortgage rate, 3.25%. Okay, so that's determined by the market. So effectively, the cost of capital is whatever you're going to invest. What is that costing you? Okay, or what do you require of that money? All right, so whether you're borrowing it at 10%, or you say, I need to earn at least a 10% return, either way is how you can determine that cost of capital. Now, logically, Riskier businesses, riskier projects should have a higher cost of capital. Less risky should have a lower cost of capital. So that's really how that's determined. Now, that gets to be like a super involved process. You could talk about weighted average cost of capital, betas, and all of this stuff. But on an individual project basis, most companies will have what they call an internal hurdle rate. And that hurdle rate is synonymous with the cost of capital. So usually it's internally determined by a company when they're assessing projects. They'll say all our projects have to earn at least 10%. Okay. But that's a very good point because it's like, all right, that's the big factor here. But the other way that we could think about it is in terms of risk. All right. Riskier projects are going to have higher costs of capital. Less risky projects are going to have lower costs of capital. You could think about it in terms of companies, high growth startup type companies without a long track record, higher cost of capital. Long-term stalwart companies that have been around for a while, like Verizon, Comcast, AT&T, they're going to have much lower costs of capital. So that's how we determine it. But very good question. So now we look at this and we say, okay, the cost of capital is 10%. Would we buy the software? So remember, we did that calculation of the discount factor, 1 divided by 1 plus R, or 1.1 to the T. So 1, 2, 3, 4, 5, 6, 7. And we get the value of $1, one future dollar in today's dollar terms. So that's the way that we could think of the discount factor. $1, if you look at the very bottom, $1 7 years from now is worth 51.3 cents today. All right. So when we take each of those discount factors and we multiply them by the undiscounted cash flows, we get the value of each of those cash flows in today's dollar terms. That's the key. All right. So when you look to the right, that PV, that's the value in today's dollar terms. So now it's a little bit different. Previously, we had a cost of 180,000, a benefit of 280,000, which resulted in a windfall or a benefit of 100,000. In reality, because there is a cost to those future dollars, meaning they're worth less in today's dollar terms, it's actually not 100,000. What we see is the NPV comes out to 14,737. Okay. So when you think of that 14,737, very simple way to think about it is as follows. What we're investing, 180,000. The benefits are going to outweigh the cost of the 180,000 by 14,737. So the rule of thumb with NPV is that we're going to choose all projects that have a positive NPV. Now, why is that the case? If it has a positive NPV, it adds value. Okay, it adds value. All right. So I see a question here. Does the market determine as to whether the interest rate should be compounded annually, semi-annually, et cetera? So in this particular instance, we obviously have a project with annual cash flows. So we're using an annual rate. Anytime you hear a rate quoted, it's always going to be quoted as an annual rate. So no one's going to give you a rate of 1%. And then you say, oh, okay, great. And then you have to end up making it an annualized rate. All the rates are going to be quoted as annual. Now, how does this project occur? This particular project has an annual cost. Obviously, if we had monthly costs associated with it, we would have to assess it a little bit differently. Okay. So now, using NPV, we're going to discount those cash flows in our project at the opportunity cost of capital. So the question was asked, what is that? Okay. Opportunity cost of capital, weighted average cost of capital, hurdle rate, they're all synonymous. All right. And the rule of thumb is that we're going to accept all projects or investments where the NPV of the cash flows is greater than 0, positive NPV. So if you think about it, if every investment you make, all right, you make more from the investment than it cost you, you're adding value. All right. So that's the logic of NPV. Now, the key with NPV is it compares the value of a dollar today to the value of that same dollar in the future. It's going to take inflation and returns into account. So the NPV of the project is positive, it's going to be accepted. However, if it's negative, the project should be rejected. Okay. Why should we reject negative NPV projects? Because those positive cash flows aren't going to outweigh the ultimate cost. All right. So you wouldn't want to make an investment where what you're going to make from the investment is less than what you put out. Okay. So that's the simple logic of NPV. Okay. Now, as with any methodology, there's pros and cons. The obvious pro, takes into account time value of money. All right. The fact that the dollar today is worth more than a dollar in the future. All right. And this is corresponding with or correlated with risk. All right. What we know is that those future dollars are riskier and less certain than today's dollars. So if you said, for example, hey, Ken, I'd like to borrow $1,000 from you, no problem. All right, here you go. But if you said, I want to borrow $1,000 from you in 10 years, I don't know, maybe I won't have the money. Maybe I won't be around. Who knows? So there's less certainty with those future dollars that gets captured in the discount rate. Okay. Now, here's some of the cons. And ironically, one of them is actually where payback is better than NPV. So the first one, it does not give us any visibility into how long it will take the project to generate a positive NPV. So NPV just says, take it. If NPV is positive, take it. Well, what if this is a 100-year project versus a 2-year project? That should have an impact, no? So it doesn't tell us when the positive NPV is achieved. Does it happen in 5 years? Does it have 10 years? When is that? Okay. So the timing of the project is something that we don't really get to factor in with NPV. All right. Another thing, we're accepting all positive NPV projects, but the problem with that is it assumes that capital is abundant. Well, in reality, we as individuals and companies have a capital budget. We can't just take all projects that are NPV positive. We can only do the projects that fit within our budget. So for example, if a project has a positive NPV, but it costs $100 million and the budget's $10 million, it doesn't matter that it's a positive NPV. We can't do it. Okay. So that's one of the other challenges that we have to factor in with NPV. Capital is not abundant. We do have a budget. We do have to take into account when we're going to achieve these positive NPVs. All right. So one of the deficiencies with NPV is there's no capital rationing. We're going to do all positive NPV projects. Well, we might not have the capital for it. Okay. So because resources are scarce, we're going to have to look at the NPV of each project and the size of the investment. Okay. And that's something that we're going to deal with momentarily with IRR. If we have two projects and they're both the same NPV, how do we determine which one to do? Well, it's all contingent upon how much we have to invest. All right. So fortunately, there's another measure that's going to help overcome this. That's the internal rate of return. So method 3, the IRR, internal rate of return. What the rule is going to be is that we're going to accept projects that have an IRR or internal rate of return greater than our cost of capital. Okay. So if we look at this particular instance, what we see is that when we calculate the IRR or internal rate of return, what we're going to find is that the internal rate of return is going to be that rate where the NPV equals 0. Okay. And what that's going to determine is effectively that break-even point. All right. So what would the cost of capital be to be a break-even between the investment and the cash flows that are going to result from the investment? That comes out to be 12.446. So if that IRR or that internal rate of return is greater than the cost of capital, we're going to choose to move forward with this project because the return of the project is greater than the cost associated with the project. So now what we see is that discount factor is changed based on the IRR. Okay. So that discount factor now goes down, okay, because there's greater discounting and we get the NPV of 0. Now, IRR makes a little bit more logical sense to us because the way that we talk about things are in terms of returns, okay? So as long as the IRR is greater than the cost of capital, then we're going to move forward with the project. So the internal rate of return, it's also known as the discounted cash flow rate of return, gives us a way to quantify the rate of return provided by the investment. Now, this is going to be defined as the discount rate where the NPV of cash flows are equal to 0. Now, there's a few ways that you can calculate IRR. Very simply, if you go into Microsoft Excel, you could do equals IRR and just include all of the cash flows of the project. All right. Now, you could also do it through trial and error. So if you have that NPV calculated and that 14,737, you can start increasing that cost of capital and see where that point is where it breaks even. At that point, that would be the IRR. So a simple way of doing that is we do cost of capital of 10%, we get 14,737. Then we say, you know what? Let's tick it up. Let's move it up. So let's move it up to 14. We end up getting a negative number. So then you split it in half and you keep going, splitting it in half until you get the ultimate IRR of the project. So the higher the project's internal rate of return, the more desirable it is to undertake the project. Now, the rule with respect to capital budgeting or when evaluating a project is accept all projects where IRR is greater than the opportunity cost of capital. Basically, the return that we're getting from the project is greater than the cost of the project. Simple as that. So what is the significance of IRR? Why are we interested in that? Okay. So one of the things that's going to come up is we're going to have an instance where we have two projects, but we can't do both. All right. So we might have two identical positive NPV results, but we can only do one project. We don't have the budget to be able to do both. IRR is going to give us which is the better return for the amount invested. So, simple example. Let's say we have two projects, both have an NPV of 10. We can only do one. How do we determine which one we're going to do? So we're going to look towards IRR. Because what IRR is going to do is it's going to state as follows. Hey, what's the initial investment? So we say, oh, okay, well, the one project had an initial investment of 100. The other project had an initial investment of 10. So you say, oh, wow, okay. So now it's very different. Now, even though the NPV is 10 for both projects, one had an investment of 100, which means it's an IRR of 10%. The other had an investment of 10, which means the IRR is 100%. Obviously, we want to go with the one with the higher IRR. Okay. So IRR is going to help us decide which project to do if there is an instance where we have identical NPVs. So now, what is the biggest pro for IRR? It's widely accepted in the financial community. All right. If you talk about stocks or investments of any type, buying a house, buying a business, you never talk about it. Nobody talks about it as though, hey, I've got this one that's an NPV of 10. I got this other one that's awesome. It's an NPV of 20. You'd be like, what? And what are you talking about? Right? We don't talk about them on like gross dollar terms. We always talk about it in terms of returns, percentage quantifiable returns. Okay. So this is how we talk about different investment opportunities. You get 50% on this, you get 30% on this. Okay. So that's the positive of IRR. It's also based on discounted cash flow. So it does take time value of money into account. So another positive of NPV is also a positive of IRR. And when used properly, it's going to provide excellent guidance on a project's value and risk. Now, there are three major pitfalls using IRR that are going to be worth discussing. Number one, multiple or no rates of return. So now, if you have a project that has more than one investment, or you have a project that has positive and negative cash flows that vary, you could end up having no IRR at all. So when you go to calculate the IRR, you could very well get an error. Okay. That's a problem, right? So we might say, hey, IRR, we need to get the IRR and we're not able to calculate it. Okay. So IRR is going to assume we have some sort of outflow and then we have a nice number of positive inflows. All right. But there are instances where if that goes awry and that relationship is broken, then you might get no IRR, or you could also get multiple IRRs where you literally have 2 IRRs for one project. Okay. Second, changes in discount rates. So the IRR rule tells us to accept projects where the IRR is greater than the opportunity cost of capital, or the WACC. But the problem is the discount rate changes over time. So if we think about it, we're looking at today. All right. But what about in the future? NPV, we could actually change those cash flows and say, you know what? Today our cost of capital is 10%, but we're going to be reducing our risk of our capital structure. So next year it's going to be 9.5, then 9, then 8.5, then 8. We could actually do that with NPV. We can't do that with IRR. So there's no way to account for the fact that discount rates are going to change over time. Another key factor is IRRs do not add up. If we use our billing and collection software example, and we say to ourselves, okay, billing and collection software, we're going to have to do a software update in year 4. And that software update is going to cost $10,000. All right. We can't do an IRR for the first 4 years and an IRR for the last 3 years and then add them together. It's not going to work. There's not a way to kind of add them up. So 3 well-known deficiencies with IRR that has to be incorporated. Okay. So now, big question. What do we do when the methods conflict? All right. So there are instances when there might be a conflict between NPV and IRR. So which do we go with? All right. So we already said if we have the exact same NPV, we could figure out which to go with looking at IRR. But what about this? NPV tells us to go with one project. IRR tells us to go with another project. What do we do? Okay. So I'm going to pose this to all of you in the chat. I give you 2 choices of an investment. Which would you choose? Investment A has a 100% rate of return. Investment B has a 1% rate of return. So just pop into the chat A or B. So A, you get 100% return. B, you get a 1% rate of return. Which would you choose? A or B? Pop it into the chat. Okay, B, A. Okay, A. So you want 100, you want 1. Okay, so some say that A sounds unrealistic. Some are choosing B. Some are saying need more info. Okay. Yeah, and again, like you're just looking at what the info provided. Okay. So people are kind of like, okay, is there a trick to this? What's going on here, Ken? I feel like you're trying to trick us here. So what we're actually going to see is there's a conflict here. Okay. What IRR is telling us is go with investment A. So then we're going to have to say, well, what does NPV tell us? We don't even know. We don't have that information yet. So now, what if I told you that most people would naturally choose investment A without any further information, myself included. But what if I told you investment A was based on a quarter? So you give me a quarter, I give you 50 cents back. Investment B was based on $100 million. So for those of you who chose the 1% return, congratulations, you end up with $1 million because that's based on an investment of $100 million. So 1% of 100 million, that's going to give you $1 million. So based on IRR, you would choose investment A, but based on NPV, you would choose investment B. So remember this, if there is ever a conflict between IRR and NPV, we always go with NPV because it takes size into account. All right. I think we would all prefer $1 million over a quarter. Okay. So remember, if there's ever a conflict, NPV or IRR, always, always, always go with NPV. All right. So present value versus future value. $1 today is worth more than $1 in the future. And that's something that we have to take into account when we conduct an analysis like this and when we try to make sound financial decisions. We went over 3 methodologies: payback, NPV, and IRR. What's great about payback? Very simple, easy to calculate, easy to understand. It's a rule of thumb. It's a cutoff based on a particular time frame. I need to make my money back in 3 years, 5 years, what have you, okay? Major deficiency though, that's not the way the world operates, specifically the fact that those future dollars are worth less in today's dollar terms. So what can we do to overcome that deficiency? NPV. NPV is going to take time value of money into account. We have a particular cost of capital associated with that project. We're going to discount those future cash flows based on that cost of capital. Okay. So it's great. It's taking time value of money into account. So we're going to go with every project that has an NPV of greater than 0. But what are the issues with NPV? Well, it's going to assume that capital is abundant. We have an unlimited budget. That's not realistic. Okay. Now, is there some way that we can overcome that? Yes. That methodology would be IRR. So IRR actually quantifies the rate of return. That's the way that we're going to look at all investments. How much are you going to make on that investment? 20%, 30%, 50%. Okay. We don't talk about investments in terms of NPV, right? Gross size that we're going to make. All right. So IRR is more commonly used, and I think it's a little bit more intuitive as well. So then we gave an example where we have 2 projects with identical NPV, but we can only do one project. So how do we determine which to do? So if you have the exact same NPV, you could lean on IRR to make that determination. So I gave the example 2 projects that have an NPV of 10. One has an initial investment of 100. The other has an initial investment of 10. So what's the IRR? The IRR for one is 10%. The IRR for the other is 100%. So simple decision, we're going to invest in the one with the higher IRR. But then we said, what happens if there's a conflict? NPV says go with this. IRR says go with that. What do we do? So we think back to our previous example with our buddy Al Einstein there. What are we going to do? We have a 1% IRR. We have 100% IRR. Well, if there's a conflict, we go with NPV. So in that particular instance, we would rather have $1 million than a quarter. So in that instance, we would rather have a 1% IRR as opposed to 100% IRR because we end up with more actual dollars. So NPV is going to look at the actual gross dollars. That very simply, folks, is how companies look at projects, how we should look at investments, whether it's a piece of real estate, a potential business, or even a stock. So please feel free to pop into the Q&A. I see a question waiting there. I'll address that. So pop into the Q&A if you have any questions based on anything at all whatsoever about this. I see, like the name, Ken. How does our NPV risk adjusted differ than NPV? Thanks. So effectively what risk adjusted is going to do is it's going to take into account what I mentioned when we were talking about IRR, the idea that risk is going to change or vary over time. So in the case of like a risk adjusted NPV, you're going to actually change the cost of capital over time. So that's the advantage of an RNPV as opposed to NPV, because it does make sense that companies are going to change their cost of capital over time. So as companies take on more debt, that's going to typically reduce their overall cost of capital. As they pay debt, that's going to increase their cost of capital. So that's what the difference is. So effectively, it's still NPV. All you're going to do in that particular instance is you're going to change that cost of capital with each of those annual cash flows. But it's effectively the same methodology. You're just not using a single point estimate for cost of capital.
So people can continue to use our Q&A box to submit questions. And I wanted to pose a question to you, Ken, that had been received to us in advance.
Sure.
And it was from someone who asked about when you have invested in property, and I'm not sure if it was purchase or rental,
Mhm.
but they had asked about, they invested in property to live close to work, but
Mm,
now are in a work from home,
yeah,
and they're wondering about whether they should move.
sure. Um, so that's an interesting one because we've actually seen a lot of places are offering incentives for people that can work from home. I saw the other day, Arkansas, go figure. They're offering $10,000 worth of Bitcoin for anybody that wants to move there and work from home in Arkansas. Now, don't want to offend anybody. I've never been to Arkansas. It doesn't really seem like a phenomenal destination, like a tropical resort. But I guess if you like hunting and fishing, that might be an option. I know during the beginning of the pandemic, this one might be a little bit more appealing. Um, I believe it was either the Bahamas or Barbados offered $50,000 for individuals to move there and work from home, work remotely from there. And I remember seeing a story of a New York City school teacher that actually moved there. They got the 50 grand and they taught remotely. So that's pretty awesome. Not everybody has that flexible of a situation, but we can actually make this determination by looking at the numbers. Okay. What is that cost associated with that house? And what are you making in terms of your income? And can you move? All right. Obviously, we've had a significant increase in real estate values. Could you hypothetically sell that property at a gain, take that, and then move somewhere else, use those proceeds to live cheaper and still make the same amount of money? So really what you have to do is you have to kind of look at it as different projects almost. So it's like option A, you stay, what's that costing you on a monthly basis? The other thing to remember is real estate, wherever you live, that's the cost. All right. So in this instance, it's pretty interesting. Your benefit is fixed, right? Your salary is your salary. But what's actually, changeable is your cost of real estate. So you can move to a cheaper area, you have the same benefit. Now, I don't know offhand, but some employers might say, hey, wait a second, we were paying you New York City dollars because you were in New York City and now you're in a different location. So we're going to alter your pay accordingly. But that's where there could be a potential inflection point. So let me go back to the Q&A. Tanya, how can I learn more? What I would say, Tanya, is shoot me an email. I could give you a bunch of different like books to read up on this and give it more of like a real life flair, so that you could see it from a stock perspective, perhaps, an investing perspective and things like that. I have a few books that I could absolutely recommend to you. Next question. Is it always wise to consider the NPV when determining the rate of returns of an investment? So I would say it depends. And you could use stock investing as a really good example of this. So if I told you there was a stock that I could recommend, you could get a 50% rate of return. You say, wow, that's awesome. But you only have $1,000 to invest. You say, okay, well, what's that 50% rate of return going to mean? That 50% rate of return is going to mean 500 bucks. Is that really going to change your life? Probably not. Versus if I said, hey, I have a different opportunity for you here, and you're going to get $1,000 cash flow from that opportunity, you would be a little bit more interested in that. So one of the challenges that we have is we have to kind of pair the actual dollar amount relative to the cash flow. So just very simple example, right? If I were to tell you like, hey, let's invest in an investment property together, okay? And we could make either $1,000 a month or we can make a 50% rate of return. Which would you prefer? You would probably say, oh, 50% rate of return. The problem is the 50% rate of return is based on a lower initial investment because we're going to use more debt. So especially when you talk about lower amounts, you want to make that determination because it's not always, cut and dry, right? So it's not always like it's $10,000 and 50% or $10,000 and 10%. It'd be great if that were the case. A lot of times what it is, it's $10,000 is going to get you X percent, and then $5,000 is going to get you Y percent. Which are you more interested in? Okay. So it is wise to consider the NPV when determining the rate of returns of an investment always, because you want to end up with more value than you invested. But there's a whole host of other factors. Do you need this money? Do you not need this money? What's your time frame, et cetera? All right, cool. So if I am thinking about getting a personal loan of $30K to invest in a project, excellent. The loan rate would be the cost of capital, correct? Say the Fed might increase the rate later this year or next year, we could add maybe 0.125% for a future rate when calculated. 100%, Wesley. That's a very good real life, real time example. So personal loans are floating rate. Those floating rate loans are going to change as rates change. So what you would have to do, and we'll just continue on with this example. I think that's a really good one. Personal loan of 30,000, you take whatever the current rate is on that loan. And if you look at the terms, it'll say rates are going to change. This is floating rate, yada, yada, yada. So what you would have to do is, let's say it's 5% right now. What you would have to do is you would have to alter that over time. So what you could do is you could go on Bloomberg and see when the predicted changes in rates are supposed to occur over the next several years. And you could say, okay, it's 5% today, and it's going to be 5.125 in Q1 and on and on and on. And then compare that to what's going to be generated from that project. That's 100% correct. That is exactly the right way of thinking about it. Now, the interesting thing is, in most instances, investments are going to be as follows. You invest money, you're not going to get money back right away. So typically what's going to happen is you're going to be paying for this investment effectively in this instance, the interest, right? You're going to be paying for this investment for a significant period of time before you actually receive any return. Okay. But you're 100% correct. That's exactly how you would think about it. That's 100% how you would think about it for sure. Okay. But that's a really good question. And that's exactly the right way to think about it based upon what we've been talking about. You're really thinking about your opportunity cost. That's really the most important thing. Absolutely. My pleasure. So one of the key things that you can see from this is it's always made to be this kind of nuanced, hidden, arcane thing. It really isn't. Okay. So if you were like, what about Bitcoin? It's just another asset. All right. So it's really are you investing, today's dollars? What do you think it's going to be worth in the future? I mean, it's literally as simple as that. So we could take Wesley's example. You borrow $30,000 and you buy 3/4 of a Bitcoin. Well, what's going to happen in the future? What is the cost of that money? What do you predict it to be in the future? How long are you going to hold it? When do you have to pay back that investment? So it really is as simple as that. And remember, this is on a case by case basis, right? Where this is not going to work out is if you say, I have an investment portfolio. You say, okay, your investment portfolio of 50 investments, that's a little bit different. You have to look at it on an investment by investment basis. It's a little bit more complex when you have, multiple investments, multiple cash flows. But yeah, if you're looking at an individual opportunity, this would absolutely be the way to think about it. And it's used every single day in the real world, buying a car versus leasing a car. That's a very simple example of NPV analysis right there. What is your cost of that money to borrow it? How much do you have to put down in one versus the other? So that's an easy way to determine very simply which to go with. And people get very visceral reactions with that, which I always find funny. One of the exec ed courses that I did was at St. Peter's Hospital. We had doctors. I said, buy or lease. And people were adamant about it. I was like, folks, everybody needs to take a chill pill. I'm not a medical doctor. I can't authorize giving chill pills, but everybody needs to take one and ultimately take the emotion out of it, because some of the people are like, my family always buys, my family always leases. I said, hold on. What is the cost of financing? How much money is it? What are you going to do with that money elsewhere? So like take the emotion out of it and just put the numbers down on a piece of paper. This is literally as simple as the back of an envelope, back of a piece of paper, and a calculator. It really, really is that simple. So try to like kind of remove a lot of the noise from these analyses and just break it down. Think about this presentation. What's going out, what's coming in, and then make that determination. And understand, depending on the methodology, it's going to give you possibly a different answer. So, you know, you say, oh, I'm going to make $10,000 on this investment. Okay, when? Tomorrow, next year, 3 years, 5 years? That 10,000 is definitely different in each of those instances, regardless of the fact that the initial investment is the same. Always remember, whenever you're making an investment, your money in is guaranteed. That's determined. That's not going to change. What is going to change is the value of the house in the future, the value of the car in the future, those future cash flows, all of that stuff varies. That's why the biggest concern should always be the investment. Okay. So when you think about real estate right now, you know, most people think, wow, it's increased 20, 25%, some cases more, depending on the market. You obviously have to factor in what your cost in is, because that's fixed. God forbid you invest $500,000 in a house and only to find out that you bought at the height of the market. That's the guaranteed number, the 500,000. The future value, that's the wild card. That's the one that we don't know. Okay. And also, everybody, you can hit me up via email. It's just ken.freeman at rutgers.edu. So if you have any questions about this or anything else, just reach out to me. Out of curiosity, is the methodology applicable to poker as well? Yes, absolutely. It's odds. So really what you'd be looking at in that instance is the predictability of the cash flows. So you know that if you win the pot, that's a certain amount, right? But it's predicated on what the next card is going to be. So really what you have to do is, like, regardless, you could win $1,000, but the $1,000, whether or not you win the $1,000, is based upon the likelihood of getting the card that you need. So then you have to look at it on a percentage basis. What are the chances that you're going to get that card? So yeah, you could use it for poker. You could use it for anything. So let me type the email address, ken.freeman@rutgers.edu. I just popped it into the chat. Do you have other real world or examples like the ones you're discussing, buying a house available somewhere, other notes, books, etc.? So I think Margaret mentioned in the chat that I'll share the books with all of you when we send out this webinar, the recording, so that you'll be able to see it. But I'll give you some really good materials that you can review on your own that are very like straightforward, not super technical, that'll like really give you a solid background of all of this. And then if you have further questions beyond, please reach out to me. You can attend my classes. I mean, that'd be totally cool by me.
And my goodness, thank you so much. Those are some generous offers that went along with the thanks for an amazing presentation. There's so many practical considerations, and you just really made something that is so intimidating to most people seem really simple and that every person truly can do. So thank you for that.
Very welcome.
I want to thank our audience who had some enthusiastic participation and fantastic questions and enhanced the discussion for sure. So I'll close with a couple of reminders. So our RBS webinars take place on Wednesdays at noon Eastern, and that is the middle of the week, the middle of the day, and we also aim for the middle of the month. And for more information, you can always visit our webpage. I'll say it, but people who've registered will receive this via email: business.rutgers.edu/alumni/lifelong-learning. Our exciting schedule of topics and presenters that's lined up over the next couple of months has been thanks to great suggestions from our audience. So we encourage you to keep sharing those ideas. We want our series to continue to meet your needs. So please stay online for just a moment longer. We'll have a very brief 3-question survey about today's event, and One is a free-form field that you can type in topics or speakers you'd like to see featured in the future. And finally, as I mentioned when our webinar began earlier, a link to the archived recording of this presentation will be shared via social media and emailed to registrants. It will also be on the Business Insights page of our website. And on behalf of the Rutgers Business School Lifelong Learning Initiative, I thank you all so much and wish you a great rest of the day. Thank you.